We have a very special speaker today. We've had Gwen speak on a couple different topics for the eco-sustainability group here, and we're just so lucky to have her again. And just kind of as a background, if you haven't heard her speak before, she is a GRI, Global Reporting Initiative certified trainer. She delivers IRI or GRI training through the ISOS group, ISOS. And she's also an author of a book on sustainability reporting. And she's done many other things like writing research reports for the World Bank, being on the accounting faculty for Indiana University and Ball State University, and working as a staff auditor for KPMG. So we've got a very great speaker and interesting webinar ahead of us today.
Thank you, Nick. I am delighted to be here, and thank you for that great introduction. I'm going to jump right in, but before I do, I just want to let you know that the slides will be available in PDF form, and pretty much anything that's underlined is a hyperlinked to a website. And in fact, I have a website of my own called Sustainability Within Reach, and it's primarily informational. I do a non-blog every couple of weeks. I post it on LinkedIn, but it's on my website. So if you want to just, hover over, click on that underline, it'll take you directly to my website. And it has a list of courses I teach for the ISOS group, the certified trainings. But anyway, I will get into the material as we move along. If you have any questions, please put them in the Q&A, and somebody will be monitoring them, and we'll find out what your interests are, what your questions are. So here we go. Today I'm going to talk about the Task Force on Climate-Related Financial Disclosures, TCFD, CDP, and the Greenhouse Gas Protocol Scope 3. What are the connections across these? And there are so many acronyms that, it's like we speak in alphabet. I think that's the new language. My husband's not in this field, but he sees what I write and he says, "What are you talking about?" So it's just keeping the name straight is a chore, but also keeping straight what and how they relate to each other. So I'm going to dive into the task force. And, TCFD is an amazingly influential, it's not a standard, but it's a set of recommendations about climate-related risk and their impact on financial aspects of an organization. So I always like to go back to the question of how did we get here? It doesn't matter what I teach, where I am. I always like to go back and say, well, what was the beginning of all this? And the purpose of this task force was really to help companies provide better information. As companies are looking to borrow money, get investors, this information is relevant to investors and creditors as they think about giving money, investing. And it's more than just, will I give you the money? But if I do, what kind of risk as an investor or a creditor am I engaging in when I invest in you? So, if you say, well, I can still get the money if the higher risk I am for certain things, it's going to cost me more to borrow, and or organizations or investors are going to want more in return because it's a higher risk. So this information is really intended to provide clarity on certain risk, and in particular, climate-related risk. So that was the purpose. And the recommendations were created and released in 2017. So it's been around. It just hard to believe so quickly time goes by. And what I have provided on this slide, you can easily go click that on. That will take you to the TCFD website. And we will talk about what has changed with regard to TCFD. But I just want you to know that this website is still up. It is still has a lot of information that I'm going to dive into in just a little bit about the publications that are available, the various resources if you're wanting to learn more about TCFD. So let me go back here. The why. The why is that there was considerable external demand about this information. This was lacking. And so this organization or task force was created by the Financial Stability Board. And because climate-related risk were considered to be extremely important to assessing the overall risk that a company has. So it's one more bit of information, and these particular investors, lenders, government, they want this information. So there wasn't anything kind of put together yet that provided this kind of information. So this task force was created. It was chaired by Michael Bloomberg of Bloomberg fame. And these were a group of experts, financial experts from around the world. And again, you can, if you're interested in, go to TCFD's website, you can see who those individuals were, because I think when you look at who the people are and were that were involved in these substantial documents, then it really does help you to understand how well crafted, how thoughtful these documents are. So here is the document that is implementing the recommendations, and this was updated in 2021. It will not be updated again, okay? And but it still is valid from the perspective of looking at these recommended disclosures and how we'll talk about 4 pillars, 4 core elements that have gone on to be the foundation for the European standards, the International Financial Reporting Standards, IFRS sustainability standards, and also the SEC's proposed or passed climate law, a disclosure law. So what you learn here today will really be very valuable in understanding a whole host of other standards that have been created since TCFD's document was released. And it's a very good starting point, and maybe a good endpoint for your organization, but it's very well done, okay? And I will tell you that it focuses only on climate related. It doesn't have a social component, but this is an environmental approach. It's a investor's perspective approach, so that it is focused on the investors, financial approach, financial materiality, okay? And again, if you were to click this on, that link will take you directly to this document, and you can then download it. It's free to download, but I always like to give people direct access to something that I'm talking about. So inside this document, you're going to see that there is a guidance for all sectors. And these are the 4 core elements that I'm going to explain in detail. There's a section on governance, one on strategy, risk management, metrics, and targets. So if nothing else, if you remember these 4, you're going to see this repeated in a lot of places. Okay? And in this document is also supplemental guidance for the financial sector. So whatever's particular to banks or insurance companies, and these other financial sector segments, you can see that how they're related in particular. And then for non-financial groups, the energy, transportation, materials and building, also agriculture, food, and forest products. So there is more detail for those segments. And let me just quickly go back here to the document. I just want to, show you that it is very easy to navigate. What I love when they do these things is that they will take you directly, to that page from the content table of contents, and you can read in detail things that you want to see. All right, so I'm going to dive into the 4 core elements, and the first one being governance. And this is just at the high level, this is where the organization is going to disclose how they govern, how they manage climate-related risk and opportunities. So I think just to talk about why this is so important, if it's not happening at the higher level, at the top level of an organization, it's probably not happening. So as investors are looking at, from the perspective of the investor, I want to know how involved is the board, is management with regarding to looking over these issues, talking and making decisions regarding these kinds of risks. So at the top, we want to know what's going on. Strategy, looking at, in this category, we're going to look at those specific risks and their effect on the organization's strategy, its planning, going forward, what they're currently doing. What are these risks and what impacts do they have on the organization? Risk management. So this deals with how the company is specifically handling the risk. And we'll look in detail in terms of identification, assessment, managing, describing those things. And the 4th pillar is metrics and targets. So the organization needs to disclose what metrics they're using to manage, to assess their progress. And in addition, the targets that they have set going forward. What do they hope to achieve? So you have not only what you're measuring currently, and then what you hope to, where you hope to be in the future. So governance first. And as I said, if it's not happening at the top, it's probably not happening at all. There might, early on in the sustainability movement, I noticed that a lot of sustainability reporting and activity was really a grassroots activity. So someone in the company said, oh, wouldn't this be great? I've got this idea about sustainability reporting and activities, and got some buy-in from from a manager and began doing it that way. But it really wasn't necessarily a top-down approach. Maybe with time it became accepted from the top, but it didn't start that way. And so this is asking an organization to describe the board's oversight of both the risk and the opportunities from climate risk. So what's the board doing? B, what is management's role in this assessment and managing? So not just the board, but also what is management doing? And we look at, I'm going to go back one more. From the perspective of, kinds of responsibilities, more detail about exactly what they're doing, what are the positions, et cetera. That's important, because if you can't be specific, again, the investor has to wonder whether or not this is serious. And increasingly, the things that I read, the things that I study, say that investors really care about governance, really do. So this is a component in pretty much every one of the standards that is looked at in great detail to see how serious an organization is with regard to dealing with climate risk. Strategy, we're looking at, from this perspective, describing, tell us in this first part, describe the climate-related risk and opportunities that you've identified in the short, medium, and long term. So you're able as an organization to define what you mean by short term. Is that 1 year? Is that the current year? What is the medium term? For some, it's going to vary from company to company typically, or you can choose. And if you're at all familiar with the European standards, they're not letting you choose how to define short, medium, and long term. Those are being defined by the standards, but TCFD is allowing you to make that definition. And then describing those risk and opportunities, their impact on your business, your strategy, your financial planning. How have these risks affected your approach to what you're doing, what you plan to do, and in terms of finances? Are you going to spend a lot more on capital expenditures because of these risks, just to mitigate things? So again, that's some examples of how you might be describing this part. Part C. This one is the resilience, and we're talking about scenarios of climate change. So depending on how you set this up, you can say, well, at a 2-degree rise in the Earth's temperature, what does that mean for our company? What will we need to do, assuming that will happen? Assuming we have a 4-degree rise, what will that mean for your company's resilience with regard to its strategy? How is it going to be operating? And the scenario analysis is quite complex. So I think oftentimes companies they hire experts who are good at taking the scientific data and also incorporating that into the individual company's business model, what kind of risk they're facing. So that is often a complicated answer, okay? I want to show you some examples of climate-related risk and the financial impact. So let's take a look. TCFD has 2 classifications, and the major risk categories, the first one is transition risk, transition to a low carbon economy. These are things that society and the economy, these are transitions that are happening. And these are things that could affect a company's current and future operations. So we'll look at that in a moment. And also the second category is physical risk of climate change. So these are the 2 categories. And I want to show you, okay, within each category, we have transition risk, there's policy and legal, technology, market risk, reputation risk. And under the physical, there's acute physical risk and chronic. So we'll look at each, the 2 major categories, and I'll give you an example, first of all, from policy and legal. But before we get there, I'm sorry, I want to show you that these things have financial impacts, potentially have financial impacts. So these risks, they can affect your strategic planning, your risk management, and your revenues, your expenditures, income statement. So the whole set of financial statements here, you can have impacts from these risks across these different statements. but they're not necessarily going to be in every single item that we show here, but just to show you the, I guess, the range of things that could be affected. Okay, so we'll look at some examples here. Transition risk in particular. So policy and legal, the climate related risk. What if, and this can happen, there'd be an increase in the pricing of greenhouse gas emissions. What if there is a carbon tax? What if you're going to have to do more reporting on your emissions? What if there are new mandates and regulations on the products you already make or the services that you're already providing? If you look at some of the European laws that have been instituted, a lot of things are happening with environmental. There's a deforestation law about the products that are being made with forest products. There's also carbon influence on products that are being imported into the European Union. So again, these are products that are already existing, but as the laws increase with disclosure of the impacts of carbon on those products, this could cost the organization more money just to keep up to date on the reporting of all this, the reduction of these various emissions, and also exposure to litigation. Just recently, I keep updating my file of litigation in the sustainability arena because people have asked me what is, what's the risk of putting out a sustainability report and various things. And so in the past, typically there wasn't a lot of action regarding litigation on sustainability reporting. Oftentimes the response was from the courts, well, this is aspirational language. We're not going to hold them accountable for aspirational language. But as more and more people are relying on this information to make decisions, then litigation is ramping up. Most recently, I read a story about American Airlines, and they're just one of many companies that are facing this litigation regarding their claims about carbon neutrality, net zero. American Airlines had been advertising that you could fly with them carbon neutral. And there were people who bought tickets and said, whoa, carbon neutral, this is great. But in fact, it wasn't carbon neutral because they had taken their greenhouse gases that they were emitting, purchased some offsets. When they combined what they were emitting with the offsets, it was zero. But in fact, the airline was still emitting greenhouse gases. So they're in the middle of a lawsuit now from a customer that says it was false. So we'll see what happens. There's so a lot of companies are having to be careful with how they are, I guess, bragging about what they're doing. So it is important to be truthful. But anyway, if we look at the potential financial impacts, you look at increasing cost, okay, higher compliance cost, higher insurance premiums. And in some places around the country, insurance companies are ceasing to offer policies in different areas. The state of Florida, several insurance companies have pulled out because of the risk is too high. The risk is it's not any longer a risk, but more of a certainty that damage will happen. In California, different parts of the state, insurance companies are no longer issuing policies to homeowners for fire for new homes. So again, these kinds of financial impacts are real, and these are climate related risk. If you can get insurance, you may have to pay a substantial amount. The idea of write-offs for assets, this is part of the transition risk because you've got some assets that may be heavily involved with carbon emissions, And because the transition is to a lower carbon economy, you're going to have to get rid of some of these stranded assets, perhaps, and also increase cost or reduce demand for your product, because customers are very savvy. They want, many of them want products that are made responsibly from an environmental perspective. And so if you're not making those moves to reduce the carbon in the production of your products or the use of your products, this could result in a decline in the demand. You're losing market share. So this is just looking at policy and legal risk and the potential financial impacts. So just to give you a taste of what this means, okay? And this is the physical risk, acute and chronic. So, you know, more severe weather events, flooding, et cetera. We're seeing that in Florida, in Texas, just as we speak, those events are happening. And then the chronic ones, changes in weather patterns, more drier summers, hotter summers, sea levels rising. And so that would be chronic kinds of risk. And also looking at the potential financial impacts, you know, you can look at the cost to the company. You're going to spend more money in a variety of ways. Could be because you have to spend more to get water if you are in Arizona and you're in states that have severe water stress. This could be catastrophic in terms of what you're going to have to pay. One, if you have to relocate because you're dependent on water and lots of it, and where you are now is not going to work. So again, these are things to consider as you're looking at what are these risks and what is the financial impact to the organization. So this is financial materiality, the impacts coming in to the organization. They're affecting the assets, balance sheet items, liabilities, et cetera, your revenue, your expenses, your cost of capital. How easy is it for you to then get financing, and at what price? So these are some examples for the physical risk. So this diagram, I think, is a really good one in terms of, we talked about transition risk, physical risk, and these risks going in, affecting your planning, your risk management, and the financial impacts those have on these financial statements and your capital and financing. I want to talk about the positive side. You know, it's not all negative. So if we look at the opportunities, what can you do that can facilitate, you know, your business prospering? And so the kinds of things that you can be involved in: resource efficiency, energy source, thinking about where you get your energy. Is it, you know, fossil fuel energy? Can you make a switch? Products and services. What do you make? How can you make that product less, you know, damaging to the environment as your customers use them? What is it that makes them more efficient, more resource efficient from the perspective of recycling or the use of the product? And then we have the various markets. Can you create a product, a new one, or take an existing one and renovate it, or renovate the idea, the design, such that it is more climate friendly, uses less resources, and develop more markets for your product, okay? And the issue of resilience. What can you do as an organization to be more resilient in the terms of, you know, physical risk? Are there ways to insulate the buildings that you're in, or to create processes that you're not as dependent on so much water? Are there ways to recycle your water so that if there is a drought, that you're not going to be as stressed? A lot of organizations and even cities are now going to taking water that is gray water and recycling that so that it's not up to drinking water standards, but it's up to use in industrial capacity. So again, it saves the city money. And oftentimes there's a contract with the organization and the city municipal sanitation where that water is then brought to the plant. Even within an organization, if you have your own water system, you can have it kind of in a circular approach. In some car washes, they do that. They have the water that is used to wash the car is filtered sufficiently so that it can be reused again for the next batch of cars. So, and the same thing with watering plants and vegetation. You don't need to have drinking water, you know, watering your plants. So all these things to think about resiliency for the future. So we're going to look at some examples about opportunities and the potential financial impacts. You know, things I think a lot of people think about anyway, or get into that habit, using more efficient modes of transport. What does that mean? Is that going to be putting things on trains? Is that going to be using electric vehicles? You know, what is opportunities that you could have in terms of your production processes and distribution? Think about more efficient ways to do that. I noticed that UPS and FedEx, when you return things to companies, you can take the bag. You know, if I bought a shirt and it didn't fit and I want to send it back to the company, I've dealt with a couple of companies where they said, just take it. Just take it to UPS. And there's a label that, and they put it in a box. They put it in a box that reduces the, you know, it's all in one big pile, organized somehow, but that it's not, I don't have to put it in a box to ship it back to the seller. So again, this is a more efficient distribution or return process. Also the use of recycling, you know, how are companies dealing with that? Can you do that? More efficient buildings. More and more companies are able to negotiate green leases with buildings so that you can say, okay, these are the things I want in the building. I want energy efficiency. I want a smart thermostat. Those are some things that could be at the beginning of the contract, you know, at the beginning of the lease, negotiated. Reducing your water usage and consumption. What are ways you can do that? A whole host of ideas could be generated. So, you know, the financial impact, reducing cost, and also increasing your capacity to produce more. The value of your fixed assets could go up because you've got a very efficient building. If you own it, you had it built under those specs, then you have a building that is very low cost to run. And so its value, if you want to go sell it somewhere down the line, has increased. And then people who work for the company, these are things I think that sometimes are undervalued, that employees want to feel good about who they work for. So the things that you are doing to making a less, you know, harmful impact on the environment could really boost the morale of people who work there. And I know that a lot of people who look for jobs, they look at the sustainability report of companies. They're actually reading those and saying, I want to know, what are you doing? And so from the perspective of, it's not necessarily what's the highest paying job, but what's the job I can feel the best in. Okay, so these are really important things. And also, if you can reduce, you know, you go from volatile compounds in making something and you go to a water-based solution, that can dramatically improve the health of your workers in the plant. Risk management, here we're looking at, these are disclosures. Explain to us, how do you identify a risk? How do you, how do you describe the management of those risks? What do you do? And then how do you take this process of identifying, assessing, and managing and putting it into your regular overall risk management approach? So rather than saying, this is a separate area, but it's all part of our entire risk management, how do you do that? So again, explaining, these are descriptions of how you do things. And the more clear you are, the more specific you are, the better it is from the perspective of someone trying to understand those risks. Metrics and targets, looking at the metrics that, disclose, what are those? Tell us. And then B is disclose scope 1, 2, and if appropriate, scope 3, and the related risk. And then C are the targets you're using to manage these risks, to keep the risk low. What are you setting as targets to achieve? Okay. All right. Now, so the connections, what are the connections? In 2018, CDP aligned with TCFD's recommendations. So, and again, this is saying TCFD recommendations are the basis of many disclosure regulations. So just to highlight how important TCFD disclosures have been. CDP also took these recommendations and the pillars, and they put them into the disclosure questions for CDP in a very standardized format. Okay, so TCFD has been adopted around the world, and the task force has disbanded, okay? But it doesn't mean these recommendations are no longer valid. They are still valid. What has happened is all the information regarding TCFD has been folded into the International Financial Reporting Standards, IFRS Foundation in 2024. So what that means going forward, there is an International Sustainability Standards Board, ISSB, IFRS Sustainability Standards, and these standards build on TCFD's disclosures. Okay, and I'm going to show you how they built. But just to show you the connection, CDP has been on board with TCFD since 2018 in and directly into the questionnaire. And the questionnaires for CDP would say, this is TCFD management. This is TCFD board level disclosure. So you knew the direct connection as you went through the questionnaire. Now, I want to describe a little bit about the IFRS sustainability standards. There are two. One is called S1. This is about sustainability risk and opportunities that could be reasonably expected to affect the entity's financial materiality. So cash flow, cost of capital, short, medium, and long term. Now, the second standard, S2, is about climate-related risk and opportunities. So this is intended for financial report users. People are used to reading financial statements. That's what this is all about. So let's look at the connections with S, and that's the most direct connection, S2 and TCFD. So we'll take a look here, and what we find is that S2 is consistent with those four pillars, okay? Governance, strategy, risk management, and metrics and targets. They are consistent. Okay, now, where they differ Okay, there is a little difference, and the difference will be not on the recommendations, not on the core recommendations, but on the guidance and some of the recommended disclosures. So it's a step up from TCFD, but it's very compatible. Okay, and this particular document right here that is available for download has all the details of how IFRS S2 is connected to TCFD. And I'm going to show you a little bit in my slides, but I wanted you to know that this document be very handy if you are doing TCFD and you're thinking about, you're going to continue with CDP reporting, knowing what it means for TCFD used to be in the past in CDP, and now S2 is in the CDP questionnaire. So what are the differences? Okay, there's 3 forms here. One is different wording. S2, IFRS S2 uses some different wording to say the same thing, okay? And when that's the case, the words broadly consistent is what you're going to see as that comparison. Second thing is more detailed information is required by IFRS S2 than was with TCFD. And the third one is, again, asking for more additional requirements and providing more guidance. So those are the 3 specific differences that you're going to see between these 2. So we'll look at a couple of the comparison tables here. This is, okay, so here we have TCFD on the left-hand side and those 4 pillars. And looking at IFRS S2, governance broadly consistent. So that means the wording might be different, but saying the same things. If we look at strategy, it again is broadly consistent, but there's an emphasis on industry-based guidance. And then additional information regarding resiliency. But it does not specify climate-related scenarios. Remember I said TCFD, that's one of the disclosures was looking at different climate scenarios. IFRS S2 does not specify that, which ones to use. Provides also application guides and reliefs. So sometimes there are delays in when a company has to have certain information in reporting using IFRS S2. So you're given some kind of leeway. Maybe not the first year, but maybe the second year you need to have this information. And also risk management. What is added here is the monitoring of opportunities, which was not in TCFD. And then metrics and targets, again, looking at industry-based metrics. And those of you familiar with the SASB standards would be an appropriate industry-based set of metrics to use. Additional disclosures about greenhouse gases and the planned use of carbon credits. That's not in TCFD. Also, additional application guidance and reliefs, again, giving you more leeway, another year or 2 to get that information because you may not have it yet. I want to dive into governance in detail, but I'm not going to really read through this with you, but I just want to show you, here's TCFD, here's IFRS, and here are the 2 different disclosures. And then I want to go to the next one, strategy in detail, and just highlight that they tell you that anything is in bold text, it's additional specificity in S2, but it's in line with TCFD. Anything in red bold text is a requirement that's in S2, but not in TCFD. Okay, So just to get you, down the road, if you want to take a look at the difference. And what I will tell you is that the IFRS standards, okay, they're not required unless they are. I know that sounds really stupid. They're not required unless you're in a jurisdiction in a country that is going to require these standards. The US is probably not. But there's like 20 countries that are adopting IFRS standards for companies that are going to be operating using the stock markets, et cetera. Brazil, Singapore, there's a list of Malaysia that have already started this process. But for most of the companies in the US, they're not going to be contending with IFRS standards unless you're doing the CDP questionnaire, and it'll only be related to S2. So what exactly does that connection look like between S2 and CDP? So the 2024 questionnaire, which came out very recently, a month or two ago, is aligned with S2, okay? And for companies that want to achieve compliance with S2 eventually, this is a good tool to start with CDP. And CDP will be providing guidance with regard to how disclosures can progress in meeting the IFRS S2 requirements. But that's not available yet. And you will find in the IFRS governance, strategy, risk, and opportunity management, and the processes that are, to identify, assess, prioritize risk, opportunities, metrics, and targets, including scopes 1, 2, and 3 emissions. Fully incorporates the TCFD recommendations, which CDP was already aligned to. Okay. Any questions?
Under governance, is leadership covered? Because it seems to me that the transition over the next 20 years is going to require a different profile in the leadership teams of every company, board and management team. But is it covered in any way, shape, or form? Because I haven't heard any reference about explicitly trying to define what leadership looks like. So that's one question I have, and
okay.
I don't know if I should proceed with the rest of the list and leave it for later. But one that's maybe more relevant to now versus the first question is I'm trying to understand the relationship between IFRS 2 versus ESRS, which I thought was the execution of the law under CSRD. And where does ISSB really fit? Is the IFRS really the place where the information from ISSB winds up eventually nesting in?
So they are working on interoperability between IFRS and ESRS. And so again, IFRS standards are voluntary unless you're in a jurisdiction that requires it. So the ESRS, the European standards, are mandatory if you fit those thresholds of operating in the Europe, in the EU, be it an American or non-EU company or an EU company. And so, and you will see in the ESRS standards, all 4 of these pillars show up again. And there are 1,000 data points in the European standards. You don't have to do them all because some of those data points were based on assessing what's material to your organization. I hope I'm addressing your.
Yeah. It was the optional and mandatory that kind of got me as to who feeds what, but ISSB really is the one that would in fact be the information place where it's consolidated and fed up to both. I mean, well, not both, but it would be feeding that information up, because I've have a diagram and I want to correct it if it's wrong. Well, I show that ISSB, in fact, is a consolidation of TCFD. It's a consolidation of SASB. No, yeah, FASB, and no, yeah, and it's also in alignment with GRI and CDP. Well, you're established the CDP thing immediately, and I know there's been announcements about GRI, but I'm trying to make sure that my diagram, my explanation is correct when I talk to people about who's fitting what. But I didn't understand that IFRS was optional in some cases, but mandatory in others. But that would be under ESRS. So I was just trying to.
And separate, and they're separate because, you know, there may be data overlap, but and information overlap, but in terms of they are separate, and they are going to work on showing you how they are, you know, connected. But for now, if you're obligated to do ESRS, you will do it. IFRS, you will do it if you're in a jurisdiction that requires you to. So again, you'd have to know what the laws are for that, and the U.S. is not going to require it.
Okay.
That's the SEC climate disclosure law does take the 4 pillars, but again, it's not the same thing exactly, but there is overlap.
Okay, great.
But send me your diagram and I'll look at it.
Okay, will do.
So making this connection here to greenhouse gases, because we said TCFD, that's, you know, greenhouse gases, want to know scope 1, 2, and if 3 is appropriate. Okay, so so I brought the metrics and target disclosure, recommended disclosure B, and so this is where it says this is organizations should provide their scope 1, 2 greenhouse gas independent of a materiality assessment. So tell us what it is. Give us your scope 1, scope 2, and if appropriate, scope 3 and the related risk. So it says they should consider disclosing scope 3. Okay, again, is that appropriate? And here they are specifying the greenhouse gas protocol methodology for aggregating across your organizations and jurisdictions, and also looking at generally accepted industry specific greenhouse gas efficiency ratios. Okay, so just stepping back, looking at the 3 scopes, you know, these are the 7 gases, and this diagram appears everywhere. You know, and so just to scope 1, direct emissions, that you control those emissions, your cars, your buildings, that you own and control. Scope 2 is the emissions from your purchased electricity or energy. So scope 2 is indirect, but it's a very special indirect. Okay, and then scope 3, what are the scope 3 indirect emissions? And just a definition, emissions that are indirect ones that are not owned or controlled, but related to upstream and downstream activities. And there are 15 categories of scope 3 emissions. And here I have linked this technical guide from the Greenhouse Gas Protocol. And I think it's a very thoroughly done implementation guide or calculation guide for coming up with the values for scope 3 emissions. And they're not easy, okay? They are not easy to do, but this I think is a well done. And also the Greenhouse Gas Protocol is in the process of being revised, a new, you know, revision to the corporate standard. So, you know, it's been a while, but that is going to be revised. But again, if we take a look at this, what are those 15 categories? So there's 8 that are classified as upstream and 7 that are classified as downstream emissions. And what I think is really important, and I keep hearing and reading this, is that companies not all are going to be relevant to them. And so it's a matter of going through a process of determining what is relevant to your organization to decide which ones to report on. Scope 3, for many companies, this is the biggest of the 3 of their emissions. When I can give you an example of a company, HP. And so I've been kind of looking at their reporting for the last couple of years. And so they report their greenhouse gases, and 1% of their greenhouse gases is attributable to their operations. 50% is upstream, 49% is downstream. So that gives you a sense of it's very important, you know, in terms of looking at ways to minimize, reduce scope 3 and to track it, first of all. So the companies that are looking at their scope 3, they need to say which one's relevant to us. And in this technical guidance for calculating, there is a section in here on criteria that you can use to identify what is relevant. And, you know, you look at this and these make all kinds of sense. Like, what is the size of that scope 3 emission in terms of your total? Okay. If purchased goods and services, if that's like 1% of your scope 3, that's not very big. And then the potential emissions reductions that could be undertaken or influenced by the company. How much influence do you have there? And what kind of risk exposure is related to this particular activity? Financial risk, regulatory, supply chain, things to think about when you're assessing each one of those categories. And then stakeholders. Who are the critical key stakeholders? And what do they think? Your engagement with stakeholders is important to get their feedback about which ones they think are relevant. And then this outsourcing, you might have something that you previously did internally and then you outsourced it. So what impact does that have with relevance to this particular category? And in your sector, has that been identified by sector guidance that this is a big deal? For the agricultural industry, if you look at what are the things that are relevant for them, you know, in terms of the whole industry, there is a materiality guidance from the U.S. Dairy Association that helps, depending on where you are in that whole industry, what is significant, okay? If you are a farmer, then methane gas is probably a big, if you are the dairy farmer, then methane gas is relevant somewhere up and down the chain. Other things, spending or revenue analysis, that particular activity, is there a correlation with the amount of revenue that's associated with it? Okay. And then any other things that might be relevant in your assessment. So putting together like a list here and saying, okay, let's go through, let's identify a number, a range, 1 to 5. 1 being very low, 5 being very high. So have different people in the organization go through and make that assessment. Now, what I want to then do is show you just briefly that within this with this guidance for calculating scope 3, there's discussion about, you know, where you're getting the data. If you're getting it directly from the supplier, is it supplier and averages? Is there a combination, a hybrid set of data? Is it just average data for the industry? And again, is it spend-based method? Is it based on how much you buy of that particular item? But that has problems, okay, because inflation, et cetera. Just because you spend a lot of money on something doesn't necessarily correlate with, you know, the greenhouse gas. So again, there are also environmentally extended input-output models, EEIO. These are models that are already established that provide information about certain types of products and the scope 3 greenhouse gases. Okay. And in this guidance, there's more detail on, you know, ways that you calculate the scope 3. But I do want to go through some of these to give you a feel for what is in this guidance. So first of all, I'm going to look at the upstream categories, and just let me know how I'm doing on time, Preston, if we're doing okay.
I think so, yes, but
Okay.
a little tight.
Okay, I'll just pick one or two of these. First of all, we're looking at purchased goods and services. If this is relevant, then, you know, it's things like the goods you're buying there. What was involved in creating those, transporting them? And so things like office supplies, plastic water bottles, furniture, and, you know, what are some examples of primary data? What are some examples of secondary data? Okay, capital goods, so forth. So I'm not going to go through all of them, but in these slides, you will have access to all 15. I have, you know, a slide for every one of them, so that you can just, you know, get a glimpse of what is in this guide. What do they mean by capital goods? What are some ways to start reducing, you know, or start collecting data, okay, and so forth. So I'm gonna stop here and, you know, see if there are any questions, because that was the rest of my presentation was each one of these, but I don't want to go into detail if we're running short of time on this.
I can't see if everybody has been muted at all. So if they have, they can be unmuted. That would be great.
I have a question, if I may.
Sure.
By the way, wonderful presentation. Some of the documents that you showed are available on our curated website, just as a little plug right there. I do have a question in scope 3, though, about employee travel. I think it can go both ways, upstream and downstream. And the reason is I used to work in the consulting industry, and I used to travel quite a bit, too much perhaps. But I always charge my travel back to the customer. So that would be, seems to me that would be a downstream type of cost. And on the other hand, when I consider supply chain management, suppose I'm going to go visit a new vendor, to qualify a new vendor to buy their goods and services, let's say, I might fly to that vendor, then I can see that as an upstream cost. Could you elaborate on that?
That's a very good question. And if we're looking at you know, who's footing the bill? Who's footing the bill? Who's responsible for that travel? And because you said if it's a consulting work, it does leave room, I think, for interpretation. If we have everybody coming into the office every day and we're doing whatever we do in the office, whether we sell insurance or whatever, that becomes a activity to the office and to that insurance company. But like you said, if you're going and traveling to your clients and you're charging them for it and they've agreed to that as part of the cost, I'm with you. I think that would be kind of a downstream, but there's no particular category here. And I'm not sure that it would matter so much as is it in the upstream or downstream, how I put it in a report, but that I reported it. You know, if you want to then classify it, this is downstream, and we can look, let's go here and take a look at these things. Downstream transportation and distribution. So, you know, I'm just thinking, okay, you could put in here services.
Yeah.
You know, this is physical product, but I would want to easily put in here, okay, activity specific distance travel. Okay, that's where I'd put it.
Mhm. Great, thank you.
Sure.
Yeah. I do have a question on TCFD and auditability. Is it required to be audited?
No,
No. So it's purely
unless you're in a jurisdiction
that requires auditing.
and some jurisdictions have adopted TCFD as a framework for reporting for the companies that operate there. So if they said, this is what we require for reporting and we require auditing, then the answer would be yes. If not, if you're just doing it for fun, you know, we do this for
Right.
fun, but if you're doing it for information, because investors are saying, hey, why don't you? Then you can report. And again, maybe some of your investors have said, I want this assured.
Mm-hmm. Okay. And just one, I'm sorry, go ahead. I'll be quiet.
It was, if you have something directly related to that, Preston, you can go first.
No, it's just, I'm going back to an old question about leadership, but why don't we continue?
Gwen, this might have the same answer, but I was curious, how do companies know if they need to report on scope 3? Is that required by jurisdictions, or could that be a thing that investors are asking about?
If could be if investors are asking, I think the requirement, if you look at CDP, and CDP has, you know, the different scopes, and it has all 15 categories in there in the questionnaire, and you can say relevant, not relevant. So you then specify this is not relevant to us. And I think most companies, you know, they have determined, or they can determine how relevant it is. The SEC's ruling for climate disclosure, initially scopes 1, 2, and 3 were going to be required. Scope 3 has been thrown out as a requirement, but scopes 1 and 2 are still there. So again, you'd have to look at what are the laws for scope 3. I think, I'm trying to think about the California bill.
Yes, it is. It does require in California. And they, in a separate law, they actually require TCFD-like reporting.
Okay. And they will require auditing assurance. So again, some places will say scope 1 and 2 only, and then the level of assurance, the SEC and the European, it's going to start out with limited assurance and work up to reasonable assurance, which is more. It's like a financial statement audit. Reasonable, the best you can get. Limited is limited. They don't do as much work to make a conclusion. And the conclusion is really in a negative way. It's stated negatively. Nothing has come to our attention that would make us think that it wasn't properly reported. So it's double negatives on purpose because they haven't done a full assurance job. Okay.
Thank you. Sure. I also just opened the Q&A box. It looks like Paula said our chat box is disabled, so please put your questions in the Q&A option down at the bottom instead of the chat. We do have a question from Warren that I'll go ahead and read out.
Okay.
How do you navigate the TCFD requirements if you're a private company, as we look at CASB 261 that will require public and private companies over 500 million in revenue in California to complete a TCFD assessment?
Mm-hmm.
So, you know, of all the reporting of climate related risk, TCFD starts out the most basic, I think, because there's a lot of describe describe your board's activities with regard to managing this or overseeing, describe management. So there's a lot of description that, and if you're not there yet, be transparent. We are working on creating this process. This is where we are now. And we plan, because transparency is really important with investors saying, okay, you're not doing it now, but you plan to. Tell us how you plan to. I think that's really important in getting going, and you're much more credible than being, if you're vague and you don't provide information about your plans, people, it's often go the negative route. Like, what are you hiding? What are you trying to, keep back from us? But again, taking all the 4 pillars, looking at the disclosures recommended, and do the best you can with that. You may not have all the data for your scope 3, and you're working on that. What's the plan there? Is it relevant? Have you gone through a assessment of the scope 3 items? And what is that assessment? Have you done it? So again, being transparent, giving details really goes a long way.
So
Yeah.
what's the current status of leadership within the understanding of governance?
And I think GRI does a really good job of that, because GRI has some required disclosures about the competence of the board. What is it that, how do you know the board is competent in these areas? Explain that. And also, are you evaluating the board? How are you evaluating the board? So, do you have criteria? And increasingly, I'm seeing all kinds of opportunities for boards and management to learn about sustainability. There's a whole host of, there's an organization called competentboards.com, and they provide all kinds of trainings for CEOs, board members. University of Michigan, the Ross School of Business also has courses for executives. And there are several, and I don't have them on the tip of my tongue, but if you do like a search for board or executive training on sustainability, a lot of things start popping up. So it's a matter of getting the board members on board with that. In fact, in a training I had, a GRI training, I talked about that. And this company, that's one of the things they do, is to facilitate board knowledge. And she said that if a group says, well, we don't know anything, and then she says, well, let's learn. And she said, some of them who don't want to do it, and they don't stay long. They're not on the board for long, but that is evolving, and it is getting better. So there's.
Right. Can you please just do a tour of your website with your blog? Because I think everybody on this webinar would appreciate that and probably want to join up and get your updates and peruse it, because it looked very informational. And this is beyond your work with ISOs. This is your personal, professional stuff.
And I just briefly, little tidbit, this is a fountain on Indiana University's campus. It is a beautiful fountain in the heart of the campus, and I just like it. So it's part of my logo. So what I have on my website, I have the courses that I teach through ISO's group. So it's not, they know that I have this, and, it helps to advertise the courses that I'm teaching with them. And these are the upcoming ones, okay? All the way through, I do a CDP course in August, the GRI standards and the European standards. I'm doing those in July and August. If we have sufficient number of people sign up, those will be available. So those are the courses. I also have, this is my blog page. I call it Notables, it's something of note. And so the most recent one is on interoperability, the connections between different frameworks. So that was my most recent one. One I did back in end of May was, what are the IFRS reporting standards, S1 and S2? So these are kind of high level discussions of, assuming people have some basic knowledge, but you don't have to have a whole lot to read through this and get a feel for what I'm trying to talk about. And then I did one on TCFD. So that asking, why is this important? Again, so I probably about 15 of these on my website, and, please feel free to go there. And if you connect with me on LinkedIn, I will I will post on LinkedIn that I have a new notable and take you right to it. So please definitely connect, and I'd be happy to, chat with you if you want to discuss in more detail. I'm going to stop my share.
Okay.
Yeah.
Well, if I could take this up, well, I want to thank you for agreeing once again to educate us. You've always been effective. Everybody walks away with more clarity. You do a great job on that. It's been a great workshop, and I appreciate Gwendolyn coming again.